Hello and welcome. You're watching the Global Reset on CNBC TV 18 Prime with me, Prashant Nair. This is the program where we try and get you expert analysis and insights on some of the most pressing issues amid the current changing world order. Today we'll be speaking in a short while with Kinjal Shah, who is the Senior Vice President and Co-Group Head of Corporate Sector Ratings at ICRA. And the discussion very much focused on the IT services sector here in India and whether it's likely to face additional headwinds with regards to the Trump administration. Before we do that, I want to turn your attention to, of course, what's been happening and what's top of mind for financial markets. Well, it's gold. It's on your screens now. Well, the yellow metal has been making headlines as prices hit another record high. And actually, this time it's a milestone for the safe haven product. Well, there is demand from central banks, retail, funds are getting in. The reasons, of course, are well known. There's currency debasement as far as US dollar is concerned. There are geopolitical issues at stake and much more. So absolute, stunner of a rally, $4,000 as far as gold is concerned. But, gold's rise isn't new in that sense. But the tempo certainly has shifted. On your screen is a graphic which makes that amply clear. After the US abandoned the gold standard in 1971, it took nearly 38 years for gold prices to cross the $1,000 mark. I mean, that milestone was finally reached in March of 2008 during the global financial crisis. And then for the next 12 years, prices sort of meandered, went up, went down. But the next leap really was, of course, quicker from the first one. So gold doubled to $2,000 by August of 2020. And this was fueled by economic uncertainty of the COVID-19 pandemic. So as I said, from 8 to 2020, it took 12 years for gold prices to go from $1,000 to $2,000. Well, the pace since then has accelerated dramatically. Remember, 38 years, 12 years, and now from 2020 to 2025, it's been 5 years. So earlier this year, on March 14th, that is 2025, a few months ago, spot gold prices broke through the $3,000 barrier for the first time. The climb from $2,500 to $3,000 took just 210 days. And now last night, gold prices crossed $4,000. So, it's been absolutely a generational rally as far as gold is concerned. We've been trying to get you as much opinion as we can around what's happening with gold, and in line with that spirit, this is Neeraj Seth, founder and CIO at 3R Investment Management. He's, of course, a veteran at BlackRock earlier, and also Lawrence Belanco of CLSA with a technical view as far as this gold rally is concerned. Listen in.
So I remain positive on gold. I don't think gold is going to lose its shine anytime soon. If you take a step back and think about what's happening in the world, the combination of geopolitical divide, the fiscal deficits that the governments are running in the developed world, the faith on the fiat currency. So gold is playing a role of a safe haven and an alternative currency in people's portfolio. And you do see that diversification element playing through the the central bank reserves across the globe. So you've seen the uptick in the central banks buying gold. You probably will see another wave as the retail obviously chases some of these rallies. So I wouldn't be stepping away from, in fact, involvement in gold. If anything, if I take a 12 to 18-month view, I think there's still upside.
So no revision of the targets. In fact, what we've seen last week is the advance in gold is now taking price action to a 20% premium to the 200-day moving average. And if we look at the behavior that we've seen historically when gold gets to that 20% premium, we typically get a blow-off move. And what I mean by that, we get this accelerated move higher. So we still think we can push towards that 4,100 area. But what is likely to follow that kind of blow-off move is a multi-month consolidation. From a longer-term side, we think that consolidation pattern is another sort of stair step in the longer-term uptrend in gold. But shorter-term, take some profits around 4,100 and look for a consolidation to develop.
Well, those are some views coming in as far as gold prices are concerned. And we'll continue to get you as much varied opinion as possible on what's happening with gold. Well, moving on to another pressing issue, Commerce Minister Piyush Goyal has said that the Indian government is in active dialogue with the Trump administration on trade negotiations. Speaking to my colleague Parishit Lusra in Qatar, Mr. Goyal added that India will resolve trade issues with the US in the near future. We want to play out a short snippet. Remember, the India-US negotiations in a way has moved into the background lately, not very much by way of sound bites one way or the other. But here's Mr. Goyal, the Commerce Minister, speaking about what's going on.
As regards the tariffs, I can give you one data point. Tariffs have been in play for some time now. But despite that, our exports in the current year, in the first 6 months, are up by 4 to 5%. So India is a very resilient economy. The Indian businesses are not overtly dependent on exports. And I'm sure we'll be able to also come to terms and resolve issues with the United States in the near future. In any case, when we had launched the bilateral trade negotiations, we were looking at a fall October-November deadline. India is more focused on a very proper WTO-compliant, focused agreement with the US. And I'm quite confident that even next year, we will probably do better, and World Bank will be required to once again upgrade next year's forecast as well.
So what is the current situation of our trade negotiations with the US? You spent a considerable amount of time there. Minister Jaishankar, he was speaking at an event in Delhi where he said we are yet to find a landing ground in the negotiations. How would you describe the current state of play? Where are things right now?
We're in very active dialogue, and there's a deep understanding of each other. I'm quite confident that we will be able to resolve the issues that are on the table and find the landing zone in the near future. As long as both countries and the negotiators respect each other's sensitivities and agree on a fair and equitable, balanced trade agreement, which will also help to balance trade deficits in the long run. I'm sure this will be a very positive development, which we are all working towards.
What has also changed in the last few weeks? When you were there in the US, you made a point that US is going to play a very critical role in the energy partnership and India's energy requirements in future. How do you see the energy ties expanding?
If you recall, that conference was about renewable energy largely. And that statement was made in the context of clean energy and renewable energy. We also are looking at exporting to the US green hydrogen and green ammonia from India. And I think India would like to have relations across the world, particularly in the context of resilient supply chains and also as a contributor to the sustainability efforts of the world.
Well, that is Piyush Goyal in conversation with my colleague Parishit Lusra on Indo-US talks. Well, the global economy may be facing uncertainty, but one thing is clear. Consumer behavior is constantly evolving. My colleague Shireen Bhan had an in-depth conversation with Alex Chris, PayPal president and CEO, who shared some insights on the latest trends shaping the way people in the US shop, travel and spend, from the rise of buy now, pay later to the growth of cross-border transactions. Listen in to this very interesting slice of that conversation.
Well, since we're talking about the US, let me also get a pulse check from you on what's happening as far as consumer spending is concerned, not just in the US, but also across the other markets that you operate in. There has been a resilience that we've seen through all the uncertainty and the volatility. The headlines may be screaming different things, but consumer spending has held up. What are the indicators that you're picking up on in terms of consumer preferences, where they're spending, how they're choosing to spend today?
Yeah, so again, there is an incredible amount of noise in the world right now, but consumers are resilient. And it's actually very inspiring to see how consumers manage through and block out the noise. I think the only big shift that I would highlight is something I touched on earlier, which is a shift away from debt and towards buy now, pay later. And again, buy now, pay later is a much shorter term, much lower value ability to spread payments across. And that is actually a sizable shift that we're seeing, particularly in a younger demographic. So it's really away from credit cards as their vehicle for credit, and towards buy now, pay later.
So buy now, pay later is the big shift that you're seeing as far as the younger demographic and the younger cohort is concerned. What are some of the other interesting trends that are emerging that you intend to tap into, and perhaps this audience here could focus on as well?
There's a lot of travel that's opening up now, right? I think there was a hunger coming out of the pandemic to actually get back out into the world, which is why cross-border transactions, things like PayPal World, where people can now travel the world with their domestic wallet and make the purchase. Those are the types of trends I would think about. So, obviously, whenever you start something, you want to solve the local problem, but local problems are becoming global because it's how consumers want to spend. They don't look at themselves just as within a certain community, right? I mean, think about how big of a shift that's been. 10, 15 years ago, people bought from their local community. Now they can go online and buy from anywhere in the world, and they want to travel anywhere in the world. And so those are the types of trends that we're thinking about.
Well, I think the U.S. consumer remaining very, very resilient. That's been the story. I mean, the U.S. Economy, despite lots of calls over the last many quarters, actually, that it's going to enter a slowdown, started with the recession, nothing of the sort. High frequency data still very, very strong. We slip into a quick commercial break here. Up next, we'll be, as promised, joined by Kinjal Shah of ICRA. We'll talk about the IT services sector here in India. Stay tuned. Welcome back to CNBC TV in Prime. You're watching the Global Reset. Well, today we're diving into a new ICRA report that takes a close look at the Indian IT services industry and the changing policy landscape in the US that could reshape the so-called American dream, from steep hikes in H-1B visa fees to the proposed Hire Act that could see tax outsourcing. The report warns of new headwinds for India's $250 billion in IT exports. We will in just a bit be joined by Kinjal Shah, Senior Vice President and Co-Group Head at ICRA. Well, allow me to quickly list the three main points that Kinjal and our colleagues are making in that report. The US remains the single biggest growth market for Indian IT, accounting for more than half the sector's revenues. ICRA notes that discretionary IT spending has stalled amidst economic uncertainty and new tariffs. With delivery models already under strain, Indian tech giants face tougher execution risks ahead. The new visa norms are designed to discourage foreign hiring. Starting September 2025, US employers will pay a steep $100,000 per year per new H-1B visa, up from just a few thousand earlier. But ICRA finds that for large Indian IT firms, the direct financial impact will be limited, around 1% hit to operating margins. The broader sort of talent pipeline could tighten. Now, the real threat, ICRA says, comes from the proposed Hire Act. This is a 25% outsourcing tax, which could wipe out India's cost advantage and pressure both revenues and margins. Remember, this is a proposal. It's in the Senate in the US, but we don't know whether this moves forward, how many people, how many senators and congressmen and women in the US are for it, against it. So we don't know whether this passes or not. Now, companies, if this does get through, may need to rewire their global delivery model, which basically means more local hiring onshore in the US, higher automation, and greater diversification beyond the US. But without further ado here now, let me go across to Kinjal Shah to take this discussion forward. Kinjal, good to have you with us here. Thanks very much. I think the H-1B bit is, I guess, well debated, discussed, etc. And everyone has had some time to go through it. By the way, just as an aside, we had a statement from NVIDIA's Jensen Huang, who said, well, we'll continue to get people on H-1B no matter the $100,000 cost. So for large American corporations, I guess talent is key because of all the technological advancements, innovation, etc., which is taking place, no matter the $100,000 cost. But the real issue is this Hire Act business, Kinjal. Let's just talk about, how do we talk about this? I mean, Is there any way to tell whether this goes through, gets passed, no? How are you thinking about it, and what are you telling clients?
Yeah, I think, see, you rightly mentioned that just giving a background and context to all this. See, currently, the Indian IT services industry is already facing some headwinds in terms of revenue pressures because of the macroeconomic uncertainties and the slowdown in the discretionary spending. Now, over the last several quarters, some 6 to 8 quarters, we've seen that the revenue growth for the industry has been quite muted. Especially in the constant currency terms. They may have some benefit because of the INR depreciation vis-a-vis the USD, but when one talks about constant currency term, the revenue growth has been quite subdued. Now, in this background, we're seeing two major changes which are coming up. One is the H-1B visa fees related hike, and the second is the proposed Hire Act. Now, as you rightly mentioned, and what we've covered in our report as well, is that the impact of the H-1B visa is not likely to be very significant. We do coverage on a sample of 15 listed entities. And our analysis says that the increase in the visa fee to $1 lakh per new H-1B approval would be limited to some 100 basis points on the overall operating profits of this sample set of companies. However, if one looks at this proposed Hire Act, which proposes around 25% outsourcing tax for any of the services that the US companies outsource to foreign entities, that will definitely be a game changer for the Indian IT services industry, because till now the Indian IT services industry have benefited from the significantly cost advantage that they have. And also because of the significant talent pool that India has. Now, a 25% tax on this will significantly raise the cost of outsourcing, and then this will erode India's core advantage of delivering high quality IT services at lower cost. As of now, there is no clarity on the current status about the overall when would the higher tax or higher act be implemented. But if that will get implemented, we do expect that the Indian IT services companies will have to tweak their delivery models. We're seeing a lot of focus on the global capability centers getting set up in India. But if this higher tax of 25% were to be levied on the GCCs as well, we will see some kind of a standstill on the overall expansion of these global capability centers. So we'll have to wait and watch until the overall Hire Act gets implemented.
So, you know, if you can use some numbers, say this 25% goes through, I mean, that's the only way to discuss this in terms of implications if this happens or not. One hopes it does not go through. But what is the sort of cost arbitrage right now between, say, you know, something done here and something done in the US? If you can put this through the prism of some numbers, Kinjal.
Sure. Let me give you a broader perspective. See, for Indian companies, roughly 55% of the revenues is coming from the US market. And a part of this would be obviously an onshoring activity, and part of this would be offshoring activity. If one were to look at the 25% tax which gets levied on the overall outsourcing activities for the US customers. Currently, the Indian IT services companies operate at an operating margin of somewhere around 20 to 23%. So to that extent, the operating margins would see some decline. I mean, 25% outsourcing tax on, say roughly, or the onshore offshoring breakup for the US market could be somewhere around 70-30. So if one were to say an additional 25% cost on that, 70% of the onshoring, the outsourcing work which Indian companies do for the US market, that would be roughly an impact of, say, around maybe you can just take 70% into that 25% extra cost on the 55% share that we have. So that would be roughly, I think, limited to around some 4-5%.
Okay, so you're saying 4 to 5, if the 25%, if takes effect, it's an operating profit margin hit of between 4 and 5% for Indian IT services firms.
That's also if they have to fully bear the cost themselves. I mean, in such scenarios, we do see that there is a sharing of the costs which happen. So finally, one will have to see that how much of these costs get passed on to the customers and how much do the Indian IT services companies have to bear themselves. In a scenario where everything has to be borne by the Indian IT services companies, they are not able to change their delivery models. This could be the impact. But we've seen over the years that Indian IT services companies do adjust themselves to these kind of policies and regulations, and typically they do not get hit so much by these changes. So one will have to see how these delivery models finally pan out and how much of the cost increase these Indian IT services companies are able to finally pass it on to the customers.
I see. I see. Got that. And we obviously talk about IT services, but the other big aspect is global capability centers, right? Delivery centers.
Right.
I mean, these are large American. I mean, in the case of for the purpose of this discussion, we're talking about U.S. MNCs which have large operations in India, and there's been a booming area. The large ones are all already here. Some of the niche, smaller ones, I mean, every week we are seeing new openings, etc. You think there also there is this kind of an implication? Although that's harder to tell, right? Because that's like for a captive customer.
Right. So the nitty-gritties have to be looked at whether these global capability centers would also form a part of this overall outsourcing services that we're talking about. But yeah, if they do form a part of the overall policy, then the 25% tax may get applied to them as well. And most likely that is what we believe could happen. And that's why I mentioned initially that we do expect that the expansion via GCCs could face some standstill in case the 25% tax on outsourcing were to be levied.
Yeah, yeah. I mean, Kinjal, useful conversation and gives us a way to think about this if it does come to that. I hope it does not. And not just this, but I hope some of the other stuff, which is tariffs, etc., also are resolved, and we move in a better direction, and hope that happens soon. Kinjal, thank you very much for joining us, though. Useful. Appreciate your time here on CNBC TV 18 Prime. Well, that's IT services companies in focus in India around, of course, fears of that higher act in the US. It's a wrap on this edition of the Global Reset on CNBC TV 18 Prime. Stay tuned. More coming up in just a bit.